Hey there. Ever thought about what it'd take to borrow like $100,000? Especially these days, you're really going to be smart about it, right? We're going to tackle a question we get all the time. Home equity loans versus personal loans. And let me tell you, in 2025, the answer might just surprise you. Forget just qualifying. Let's talk about what really hits your wallet. Monthly payments. Okay, so picture this. It's 2025, the economy's a little shaky, and you suddenly need a big chunk of change. Which loan's going to be nicer to your bank account right now? You remember those super low personal loan interest rates from a few years ago? Well, kiss those goodbye. Inflation and the Fed messing around has sent those rates through the roof, like 12% on average. Ouch, right. But here's where it gets interesting. Home equity loans are looking pretty good. Their rates have actually been going down, sitting at a pretty comfy average of 8.41%. I know you're thinking, almost 4% less. Home equity loan all the way. Hold your horses, though. There's a catch. Let's crunch some numbers to see what we're really talking about here. Imagine a 10-year loan for that $100,000. With a personal loan at 12%, you're looking at a payment of $1,434.71 every single month. Now swap that out for a home equity loan at 8.41%, and that payment drops down to $1,235 in 15 years. That's almost $200 back in your pocket every month. Stretch that loan out to 15 years, and the difference gets even bigger. With a home equity loan saving you about $220 every month compared to that personal loan. Suddenly that dream vacation or that home renovation feels a little closer, huh? So is the home equity loan the clear winner in 2025? Not so fast. There's a reason those rates are so tempting. Remember, you're using your house as collateral. Miss those payments, and you could be in for a real world of hurt, maybe even losing your home. And it's a risk a lot of folks just aren't willing to take. But before we jump to any conclusions, let's dig a little deeper into the good and the bad of each one of these loans. Because picking the right loan isn't just about the smallest monthly payment. It's about understanding those risks, the benefits, and what really matches up with what you want to do with your money. Okay, but before you run off to the bank, let's think about what you're actually going to use this $100,000 for. Say you're planning on doing some serious work on your house. A home equity loan might be your new best friend. Why? Those renovations could actually get a nice little tax deduction. Uncle Sam might actually help you out a little bit. But if you're thinking about using that money for a fifty wedding or a brand new car, well, those dreams aren't going to get you the same tax break. And here's something else to think about. Those super low rates on home equity loans, they aren't set in stone. They kind of do whatever the economy's doing. If interest rates start going up, guess what? Your monthly payments are going up right with them. It's a bit of the gamble, isn't it? You're basically betting on interest rates staying put. Personal loans, on the other hand, they tend to be a little more predictable. They usually come with fixed interest rates. So that means your monthly payments are going to stay the same for the entire life of the loan. That could be a huge sigh of relief, especially these days. Knowing exactly what's coming out of your account each month can make things a lot easier to plan. But let's not forget about those pesky fees. Home equity loans often come with closing costs, and those can add up to thousands of dollars. That can really eat into your savings, so you got to factor those in. Personal loans might have origination fees, but they're usually a much smaller percentage of the total loan. So we've talked about interest rates and collateral and taxes and fees. But there's another biggie to think about, your credit score. Both kinds of loans are going to want to take a peek at your credit history, but they might have different standards. Personal loans tend to be a little more forgiving if your credit's not perfect, but you might end up with a higher interest rate because of it. Makes sense, right? The lender's got to offset that risk somehow. Now with home equity loans, since your house is on the line, you're going to need a higher credit score to qualify. Makes sense, right? Lenders want to make sure you're good for it before they put their money on the line. So before you jump into either one, it's a good idea to check your credit part and see where you stand. So many twists and turns. But here's the bottom line. There's no one right answer. The best choice for you really depends on your own situation, what you want to do with the money, and how much risk you're willing to take. So how do you actually make this decision? It comes down to asking yourself some tough questions. Like, how okay are you with the idea of putting your house on the line? Are you going to use the money for something that could get you that tax break? And what happens if interest rates go up? Think you could still make those payments? These are some big questions to think about. Because let's be real, $100,000 is a lot of money. You don't want to rush into something you'll regret later. So take your time, weigh the pros and cons, and go with the loan that really fits your situation. Because there's no right or wrong answer when it comes to borrowing money. It's all about finding what works for you and helps you reach your goals. So do your research, ask questions, and make the choice that feels right. And hey, if you found this helpful, let us know in the comments. We love hearing from you. Until next time, stay informed and stay in control.